Hi friends, myself Subrata Mukherjee and you are watching my channel Dr. Subrata Mukherjee-Distance Learning in Commerce. Today I am going to discuss another problem on depreciation accounting. This is lecture number 13 and you can browse the other lectures on depreciation accounting in the playlist section of the channel. A firm had on 1st January 2002 machinery worth rupees 2,50,000 against which the depreciation provision stood at rupees 1,05,000 on that date. The firm provided depreciation at 10% of the diminishing value. On 30th September 2002, two machines costing rupees 15,000 and rupees 12,000, both purchased on 1st July 99, had to be discarded due to damage and replaced by two new machines costing rupees 20,000 and 15,000 respectively. One of the discarded machines was sold for rupees 8,000. It was expected that rupees 3,000 would be realizable against the other. So the relevant accounts in the ledger of the firm for the year. First of all, we will do the working for calculating the amount of depreciation. It is given that on 30th September 2002, two machines were sold that were purchased on 1st July 99. Now in this question, the written down value of the machine is given at rupees 1,45,000, that is the cost less amount of provision for depreciation. So the cost value is 2,50,000 and the provision stood at rupees 1,05,000. That means the written down value on 1st January 2002 is equal to 2,50,000, that is the original cost of the machine, subtract rupees 1,05,000, which is the amount of provision for depreciation. So the written down value on 1st January 2002 is rupees 1,45,000. Now on 30th September, two machines were sold out. So we need to calculate what is the amount of depreciation on those two machines. So I am writing here M1 and M2. So the cost on 1st July 99 is given at rupees 15,000 and 12,000. So depreciation has to be charged on 31st December 99 at the rate of 10%, and here the amount of depreciation will be 750 and 600 because 6-month depreciation has been charged here. So the written down value on 1st January 2000 is 14,250 and 11,400. Then again we have to charge depreciation on 31st December 2000, which will be 1,425. The rate of depreciation is 10% on written down value of the machine, which is 14,250. Therefore, the amount of depreciation on M1 is 1,425 and depreciation on M2 is 1,140, that is 10% of 11,400. So the written down value of these two machines on 1st January 2001 is 12,825 and 10,260. Again, we have to charge depreciation on 31st December 2001. That will be 1,283, 10% of the written down value on 1st January 2001, and 1,026. So the written down value on 1st January 2002 is 11,542 and 9,234. Now you see that on 1st January 2002, the total amount of written down value of the machine is 1,45,000. And these are the two values of the two machines within this existing machine. So I have to write here M3 and the written down value of the third machine will be 1,24,224. How I arrived at this figure? That is 1,45,000 subtract 11,542, which is the written down value of M1, and 9,234. So if these two figures are subtracted from 1,45,000, we will arrive at rupees 1,24,224. This is the written down value of the M3. Now on 30th September 2002, these two machines were sold out. So you have to charge depreciation for 9 months. So 9-month depreciation on M1 is 866 and 693 is the amount of depreciation on M2. So the written down value of M1 on the date of sale is 10,676 and 8,541 for M2. Now M1 was sold for rupees 8,000 and 3,000 is the amount which is receivable. This is the expected amount from the sale of M2. So in both the machines, we have to incur a loss on sale. So 2,676 is the amount of loss on M1 and expected loss on M2 is 5,541. Now on the same day, that is on the date of sale, that is on 30th September 2002, two new machines were purchased. So I have to write it here as M4 and M5. So M4, the cost of M4 is 20,000 and M5 is 15,000. So the two machines which were sold on 30th September 2002 were replaced by two new machines M4 and M5 for rupees 20,000 and 15,000. Now you have to charge depreciation on 31st December 2002 and this will be 12,422. The depreciation on M3 500. This is depreciation for 3 months and at the rate of 10%. So 2,000 into 3 by 12 and you will get 500. And the amount of depreciation on M5 is 375. So the written down value on 1st January 2003 will be 1,11,802 for M3, 19,500 the value of M4 and 14,625 is the value of M5. So total, the sum total of these three written down value is 1,45,927. I would like to request to note the working in your notebook carefully, because from this working we are going to prepare the ledgers of machinery, machinery disposal account and the provision for depreciation. I have prepared the structure of machinery account, machinery disposal account and provision for depreciation account. So it is given that on 1st January 2002, the original cost of machinery was rupees 2,50,000. So I have written here on the debit side to balance BD as rupees 2,50,000. On 30th September 2002, two machines were purchased for rupees 20,000 and 15,000. So sum total of these two machines is 35,000. And on 30th September 2002, two machines were sold out. So I have to write here by machinery disposal account. 27,000. You can see that on 30th September 2002, two machines, original cost 15,000 and 12,000 was sold out. So I have written here by machinery disposal as 27,000. Here the machinery account is being maintained at cost. So on 31st December 2002, the value of machinery at cost will be 2,58,000. Now on 1st January 2002, the provision for depreciation stood at rupees 1,05,000. So 1,05,000 is the amount of provision for depreciation. So if you subtract this 1,05,000 from 2,50,000, which is the original cost, you will arrive at the written down value of the machinery on 1st January, which is 1,45,000. Now on 30th September, these two machines, that is M1 and M2, were sold out. So in machinery disposal account, I am writing on 30th September 2002 as two machinery account, 27,000. Now what was the amount of depreciation that was charged on this 27,000? You have to add it up. 750 plus 600, 1425 plus 1140, plus you have to add up 1283, 1026, 866 and 693. So if you add up these 8 figures, you will arrive at 7783. So you have to write here by provision for depreciation account. So the two machines which were sold on 30th September 2002, original cost was 27,000, and against this 27,000 there was a provision for depreciation for rupees 7783. So how I arrived at this figure? I have to add up the depreciation which were charged on these two machines for 4 years. 750 plus 600, these are the depreciation which were charged in first year, then 1425 and 1140, then 1283 plus 1026, plus you have to add up 866 and 693. So if you add up these figures, you will arrive at 7783. Now a loss was incurred on sale. So what was the total loss incurred on the sale? These were 2676 plus 5541. So 2676, that is 2676 plus 5541. If you add up these two figures, you will arrive at 8217. And one machine was sold out. So I can write here as by bank 8,000, and the expected value of the machine for M2 will be written as by balance CD 3,000. So this way I completed this machinery disposal account. Please have a look at it. So 27,000 is the amount of the cost of the machine which was sold out on 30th September 2002. Against this 27,000 there was a provision for depreciation of 7,783, and I have shown you the figures. You need not to write these figures in your answer script when you are giving an exam. So for your understanding, I have recorded these figures. This is the amount of loss that was incurred on sale of these two machines, and 8,000 was received on a sale value of M1, and 3,000 is the expected value of sale from M2. Now you come to the provision for depreciation account. Now you have to transfer this balance of 7,783 in provision for depreciation account. So I have to write it here as two machinery disposal account 7783. 2,283. So this is the amount that will be transferred from machinery disposal account. On 30th September 2002, depreciation was charged on the two machines which that were sold. So depreciation on the two machine charge was 866 plus 693. So if you add up these two figures, you will get 1,559. And on 31st December 2002, depreciation was charged on the remaining three machines. So if you add up these three figures, 12,422 plus 500 plus 375, you will get rupees 13,297. So here I can write it. The amount of depreciation that was charged on 31st December, 12,422 plus 500 plus 375. So you will get 13,297. So on 31st December 2002, what is the amount of provision for depreciation lying in this ledger? So you will get as balancing figure 1,12,073. 1,19,856 is the sum total of debit and the credit side. So this is the ledger for provision for depreciation account. You can cross-check one figure. So what is the cost value of the machinery on 31st December? What is the cost value of machinery on 31st December? This is rupees 2,58,000. And what is the amount of provision for depreciation? This is 1,12,073. So if you subtract 1,12,073 from 2,58,000, you will arrive at 1,45,927. And this is the written down value of the three machines on 1st January 2003. You can also see it here that 1,45,927 is the sum total of the written down value of the three machines on 1st January 2003. Hope all the students have recorded the questions with solution and you have tried to follow the process that I have adopted here to solve the problem. In spite of this, if you find any difficulty in understanding, feel free to communicate with me through email and the contact number given in the description box. Thank you. Thanks for watching the lecture.